Listen, just get 10 to 12 times your income in term insurance and you'll be fine. Maybe. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's installation in our Myths, Mysteries, and Misconceptions playlist, I want to address this quote that I heard from a gentleman who was interviewing on the radio recently, and his suggestion was to just get 10 to 12 times whatever your annual income is in term insurance and you'd be good. So let me just begin this discussion with a question. Let me prompt you with this, what I think is a very important question. What would you say is the most important asset of your life? Big pregnant pause here. I actually want you to think about it, but here goes my response. Perhaps the biggest asset of your life is your life. All right. So I've said this before. 100 out of 100 Americans die. That just is reality. It happens. We graduate. Okay. So when we die, not if we die, when we die, there is going to be a vacuum. There's going to be a need there that probably we were providing for people around us. And I think that's worth discussing in a couple of ways. So number one, it's not a if, it's a when. So to address the if versus when scenario, let's just look at other instances where we have insurance. Let's look at our homes. Let's look at our cars. Let's look at, we've got warranties and coverages on phones and appliances and all kinds of things. So if we're going to insure the car we drive, if we're going to insure the home that we live in, if we have renter's insurance, my goodness, what life owns those things? What life is paying for those things? Shouldn't we start by covering the bases? Shouldn't we consider insuring our lives and doing so in a permanent way? We'll talk about the buy term and invest the difference take on life insurance in a second, and I have covered that here on the channel. But let's recognize that there's value to our lives and that typically, even financially speaking, that's going to increase over time. We get wiser, we have more experience, we have greater capacity and ability and connections and gifts develop, etc. To where even financially speaking, and there are other aspects that we could talk about, but financially speaking, we have a tendency to increase in value. So why not protect that in a guaranteed fashion? Why just for 10 years, 20 years, 30 years? And let's pause right there and talk about, okay, even if you go with the longest term policies that are offered out there, and let's say you take that advice from the get-go. Let's say you are being proactive, and the moment you hit adulthood, 18 years old, you buy the longest term policy that you can get. That's just till you're 48 years old. That could be only half of your lifespan with the longevity that we're seeing right now. So I'm just saying that there, in my opinion, is a lot of merit to guaranteeing the asset that's most important in your life, which is your life, is insured for the whole duration. Play on words always intended there when we're saying whole life for whole life. Yes. Okay. So if we'd insure cars, let's insure ourselves. Now, I talk with a lot of people about the different aspects of their family dynamics, business dynamics, how they're implementing infinite banking, what that means. Here's where I'm having more impactful conversations around these types of situations, because often when we think about getting insurance on ourselves, and we are hearing someone say something like, well, just get 10 to 12 times in coverage, whatever your gross annual income is. They're saying that from a good place. So I would say term insurance is better than no insurance. There are people out there who have something against insurance companies. Now, I'm not saying, there's a lot that could be said there. Insurance is voluntary, so there's that. Outside of, yes, we have to have car insurance. There are state laws that require car insurance, but none for life insurance. That's a voluntary choice. That's an election that you get to make for yourself or not. And plenty of people don't because of the views that they hold. But all I'm trying to say there is that insurance provides a service. Insurance provides a product. We can voluntarily choose to do that. Some people feel exactly opposite about the insurance companies, but insurance is just using actuarial science to say, okay, if in these parameters, okay, you want to pay a premium to get that kind of coverage for that vehicle or that body or that whatever, that home, okay, this is what that could look like. Do you want to do it? And then you say yes or no. So there's that. Private contracting between individuals. I think it's a great thing. But again, when people are saying, that's what it was. Again, when people are saying just get 10 to 12 times your earnings, they're thinking of you having protection for young children, let's say. But let's walk out what is, and that's true. So that's true. You would want to have, I think everybody should be adequately protected. Even for those that are looking to implement infinite banking, I think the sooner that you are made aware of just how much insurance you qualify for based on your age and your income and your situation, your net worth, all those things, I think the sooner that you're aware of what you're eligible for, you can make a better decision on how much of that you might strategically like to acquire for yourself. And that merits a good conversation. How much of that is in whole life insurance? How much of that, for those of you who are seeking to implement infinite banking or level up what it is that you're doing with infinite banking so far, do I also want to have some convertible term insurance where I can go ahead and acquire that protection for myself with the strategic opportunity in the future guaranteed, regardless of any health changes, accidents, etc. I can go ahead and keep doing more and more infinite banking because I got convertible term insurance as part of my plan. But we're looking to protect children in lots of these examples, whereas I'm saying, well, what's the more likely scenario, which is that we live longer, and yet we perhaps need to consider the generation that goes before us. I mean, are we not probably a generation that will be helping take care of a generation that is ahead of us? And again, if in heaven forbid, if I'll speak for myself, if I pass later in life, but still prior to the generation before me, could what I build in death benefit, in protection, help up the family tree, down the family tree, however I would like that to look? The answer is yes. The answer is yes. And then, of course, we could definitely get into the context and the conversation of if we're proactively building capital in whole life policies because we own whole life policies that we can capitalize for our whole lives, and we're positioning ourselves to have a greater and a greater access to capital over our whole lifetimes. Do we have protection while the children are young? Yes. Then do we also have greater access to capital later on in life when we are perhaps stepping in on other roles of assisting the prior generation? Yes. So I'm just saying there are so many contexts, there are so many perspectives and aspects and angles that show the advantages, to me and lots of people, of owning whole life insurance. And let's ask this question. Who came up with 10 to 12? Why not 9? Why not 14? Now, as it turns out, there actually are some general guidelines on how many times. So again, you can look at someone's gross annual income and you can look at someone's net worth as some financial gauges on how much human life value someone has, because everyone from an insurance company's perspective, they have to have some kind of parameters. Even that can seem kind of arbitrary. I mean, I understand that there's actuarial science, but the fact of someone else or something else determining how much value there is to your life. But hey, we typically like to quantify things. So here we are. So if you're in your 20s, if you're in your 30s, maybe you can get 30 times whatever your gross annual income is in coverage. Okay, so if you earn whatever you earn, multiply that by 30x, and you can get the death benefit amount that you could qualify for. And then as you get older, that's going to decrease that multiplier. So maybe it's 25 times, and then 20 times, and then all the way down to 5 times, let's say, if you are in your advanced years. So there is a guideline to how much someone, but again, that just makes me question, okay, well, if someone were eligible for 15 times their income in coverage, or if someone were eligible for 25 times their income in coverage, why just 10 to 12? Where does that come from? And again, the language typically that follows, oh, well, all you need is 10 to 12 times your income in protection, because by then, and watch this, there's not going to be anything mentioned. I've never noticed it. There's not going to be anything mentioned after this where some contractual guaranteed scenario follows. Meaning something's going to be said about, oh, well, that spouse can go get a job now. What if that spouse has 7 children and doesn't want to go get a job? Okay, or something might be said, or not even just job, something might be said about remarry. What if they don't want to remarry? Okay, what if there are no children, but they don't want to remarry? What if there are 2 children, don't want to remarry? So all these dynamics matter, I think, and I'm saying. So they can go get a job after a certain amount of time. They can just remarry after a certain amount of time. But what about, and here's the one that I first thought of, something's always going to be said about the market. There's going to be something said about investments, which insurance is not. Insurance is actually mitigating risk, where an offsetting risk, okay, you're offsetting risk. You're putting that literally off of yourself onto an insurance company that's been around for 147 years, okay, for an example, and you're just paying a premium. You picked a premium that you wanted to pay, and you're putting all that risk on the insurance company that no matter, not if, no matter when you pass, there's going to be that income tax-free windfall to the next generation or to whoever you designate. Whereas the exact opposite is what is endorsed, because it will be said, buy term and invest the difference. Well, what does it mean when you make an investment? It means that risk is inherent. It is a given. It's just part of the plan is to assume risk instead of mitigating risk. So by then, okay, if you had 10 to 12 times the coverage, by then this can happen in the market, and this can happen with your qualified plans, etc. But again, there's just so much that goes into this. And I'm not saying anything outside of encouraging you to consider the value of whole life insurance. Now, once you take that and you recognize all the aspects that, in my opinion, makes a properly structured whole life policy from a mutual company that pays dividends the ideal financial asset to own and to perpetuate the ownership of. Once you can wrap your mind around that and implement systematically buying whole life insurance that's been specially designed for banking purposes, that's what changes the whole paradigm. As described in Nelson's book, Becoming Your Own Banker. If you've not read the book, read the book. Whole life insurance, when properly structured for mutual companies that pays dividends, it's the ideal financial asset, period. Use it for banking by implementing the process of privatized banking. Game changing. It's not just ownership, it's utilization at that point. It's reacquiring the banking function, controlling and profiting over the banking in your life. And then you're just using whole life insurance. So there's always that underlying and growing, oh my goodness, growing legacy move because of the death benefit. But I'm not telling anybody, remarry, don't remarry. Get insurance for children, get insurance because you're someone's child and they're dependent on you to take care of them. And so there's a discussion that could be had there as well. And I'm looking forward to that one. Long-term care. Huge subject. It's coming. It's becoming more and more relevant. Again, and that points back to longevity. But I find it so arbitrary for 10 to 12 times to be thrown out there. Who picks that? And if you actually think about it, is that what you want? I mean, that's the ultimate question. Is that your plan currently? Are you satisfied with that plan? If you actually think about it and look at it, you're not just trying to check a box. And there's value to trying to check a box and do the right thing. But if you question your thinking about what do I have through work? What do I personally have? Okay, if you're just taking that red pill and stepping out of the box for a moment and getting your head above the water and looking at things, answer these questions for yourself. What's the most valuable asset in your life, financially speaking? Isn't it your life? Isn't it your life that leads to all the other aspects of your life? I don't have my marriage without my life. I don't have my fatherhood without my life. I don't have my business without my life. I don't have my hobbies without my life. I don't have my charitable giving without my life. All the things that I do and enjoy and want to do, it's my life, my God-given life, that I do all those things and am all those things from. So for me, it seems like something to consider, protecting that life. And then not just protecting that life, but let's move on to the living benefits. Not just the death benefit of policies, any policies, but of whole life policies. Let's move on to the living benefits, which is the much more likely scenario, that we live long, productive lives. And the more that we control and profit over the banking function in our lives, what does that mean for the next generations and the next generations? I mean, if we did, let's walk this scenario out. Let's say you, like me, consider this idea of infinite banking, and you go out and you procure for yourself whole life insurance that you use for the banking in your life. And it's got a death benefit, of course. So you grow the cash value and you grow the death benefit of that policy. Let's just say one policy, which the idea is to implement this process over your lifetime, which necessitates a system of policies. But let's say with one policy, you grow and develop and compound the cash value of your policy, the death benefit of your policy over your lifetime, using the policy, following the principles from Nelson. Think long range. Don't be afraid to capitalize. Be an honest banker. Don't do business with banks. Rethink your thinking. And you keep growing and scaling that system. And it culminates in a tax-free windfall to your beneficiaries. What then does the saying of, oh, well, you just need to go and get 10 to 12 times your, meaning your children at that time, your gross income and term insurance. Number one, I mean, how old are they? Could they get term insurance? Could be prohibitive, which if they'd had whole life insurance from the start, wouldn't matter. But if they get this, when they get this, I got my ifs and my wins mixed up right there. When they get this income tax-free windfall, do they not have enough working capital then perhaps, and hopefully have an example of what to do? Do they not have enough working capital to just go ahead and perpetuate what it is that you started, which is we'll get more whole life insurance because it's not a if, it's a when scenario, and then that's just grown and scaled and cultivated both the action of it and the thinking of it intergenerationally. Do the grandchildren have to be told, oh, you should go out and get 10 to 12 times? No. It's from that first generation, a self-sustaining system can be facilitated. And Nelson talks about that in the latter chapters of his book, really beautiful, where he's talking about that interplay between this generation having a death benefit that feeds into the next generation and that growing and scaling. And it just creates this self-sufficient banking system, family banking system. But again, I'm still trying to speak to this from the surface level of 10 to 12 times. Why? Is that a good idea? So I knew that I had to bring this saying to the channel and this particular playlist for discussion because it struck me. Who decides that? Is that so? Is that what we want? Is it just because this talking head on TV, on YouTube, on the radio said that's what we should do? So I encourage you to question that. If you've already implemented infinite banking, you know what you're about. Continue to grow and scale what it is that you're doing. If you're considering this idea, my strongest suggestion is to get a hold of the Becoming Your Own Banker book for yourself, and then let's have a consultation call about what it could look like for you to implement the infinite banking concept in your life. So if you had particular help from this video, we've got a whole playlist in this category. So make sure to take the deep dive in that playlist. Live and leave a lasting legacy.